All right, we're live with Joe Libin with Latitude Lending. For those of you who are watching this, we attempted the Facebook Live split screen. Apparently, we still have some work to do to try to figure out how that works. So we appreciate your patience with us. But I've got Joe here. Joe has been a longtime friend, a mentor. He's really been a fantastic referral partner as a mortgage professional in this industry. And it's fitting to have him on to help talk a little bit about credit scoring and just the general confusing on why there are so many different credit scores and how it can kind of trip you up as a home buyer. So really the first thing that we wanted to touch on is, what's creating all of this confusion. And it's funny because whenever you get Joe and I in the same room and you start talking about credit scoring or mortgages or all these other things, we can get into the weeds. So we'll avoid doing that too much today. But one thing that Joe and I see a lot are, multiple different scoring models really tripping up home buyers. This is something that is easy to resolve, but also very difficult to deal with if you're not prepared for it. So when it comes to dealing with multiple different scoring models, there's kind of a weird history on how we got here. If you're a real estate professional or if you are a future home buyer, you'll probably notice that there is a difference between that Credit Karma credit score that you're looking at on your phone compared to the credit score that your bank gives you when you go to apply for a car loan. And then when you go and apply for a mortgage, that credit score is going to be different as well. And that whole thing, kind of the floodgates opened back in 2011 when there was a lawsuit between FICO, the Fair Isaac Corporation, who is, they are the king of credit scores, I should say, and a small company called the Vantage Score, who was promoting their credit scoring model as a real credit score. And FICO ended up suing the Vantage Score. And throughout that lawsuit, the end result was that the Vantage Score could claim that they had a real credit score. FICO lost that lawsuit, and from then you've seen hundreds of different scoring models introduced into the marketplace directed at consumers, and it's creating a lot of confusion. And so that was really the dividing point where you have just a tremendous amount of different scoring models in use, and it's creating a lot of frustration and confusion for consumers. So that kind of leads us to how it's actually impacting home buyers. And this is something that Joe sees all the time. So I'm going to let him talk a little bit about what that impact looks like and what to watch out for.
Yeah, so thanks for having me on here, Alex. The bottom line is, as a mortgage professional, I'm pulling credit almost every day, helping folks get approved in advance to own a home or refinance a home. And so, probably 1 out of 3 clients say to me, well, my Credit Karma score says, blank, 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 780, whatever. And so I should have great credit. And the answer is you may have great credit, it really depends. And so what happens is that the Credit Karma score or some of these other, services that you could subscribe to, they've basically taken that data and it's another income stream for them. And so they're charging you, $8.95 a month to $19.95 a month for monitoring and scores and things of that nature. And that's great, education's great, but the way that translates over into when you go to get a home, it doesn't always translate over. And so what happens is that we in the mortgage industry, we pull what's called a tri-merge, and that's all 3 bureaus together. So that's your Equifax, your TransUnion, and your Experian. And what happens is we throw out the high score, we throw out the low score, and it's that middle score that counts. And so how does that affect you as a consumer? Well, your Credit Karma says, 783. That could be the high score, that could be the low score, that could be the middle score. In addition, I found that personally that a lot of times those scores are a little more rosy than what we end up using. Because the way this works is when you're going to go get, an unsecured credit card for $500, a creditor is going to look at you differently than if you're going to borrow several $100,000 to own a home, correct? So what does that mean? We use, in the mortgage industry, there's what are called scorecards. So you have these different models, and Alex and I promise not to get into the weeds, but there's different scoring models or scorecards, if you will. And so when we go to pull a mortgage tri-merge, what you see on Credit Karma generally isn't what actually ends up what I see. And I don't want to be rude or arrogant here, but it's really the scores that I pull that are going to matter to get you approved. It's not what Credit Karma says. And so I just advise people, that Credit Karma is great service. There's a lot of them that are great, but it's generally just, it's kind of a line in the sand, to kind of a place where you can start to kind of understand or know about where you are, but not necessarily what you see is what you're going to get.
Yeah.
So, make sense?
I think that you're dead on there, because one thing that we oftentimes get all the time is, well, my lender pulled a 628, and so I'm going to go talk to so-and-so lender down the street because they'll probably pull like a 660. And it's like, well, no, all of you in the mortgage world, you're working within the same box, right? You have the same walls and confinements when it comes to FICO. So, going from one bank to another, one bank might use a Vantage credit score, another bank might use a FICO 9 credit score for auto lending. So there can be huge kind of differences there, but in the lending world, you don't see that. Everything is kind of constrained.
No. In the mortgage world, we're all pulling the same tri-merge credit report. So all three bureaus, merged into one. And when a company is coded, correctly as a mortgage company, and even on the banking side, the mortgage group is going to be, coded correctly. If your credit is pulled by me or anybody else, and then anybody else pulls credit again within the next 2 weeks, we should see the exact same scores. There shouldn't be any variance at all. Mm-hmm. Now, is it 100% of the time that way? No, of course not. But we're all working off the same model, the same scorecards when it comes to mortgage financing, right? So, if I pull somebody and they're a 782, a 643, and a 698, that middle score should be the same, 743 for all of us. It doesn't matter where you go.
Yeah.
The other biggie question I get is and it's kind of an urban myth, is that people are just petrified. Well, gosh, Joe, if you pull my credit, my scores are just going to, come crashing down. And the reality of it is no, that's not true. If I pull your credit or any other mortgage company pulls your credit, you're going to see, a couple points there, from an inquiry, but it's not going to crater your score. It's not going to have really, at the end of the day, very, very little bearing. And as mentioned earlier, as long as if anybody else in the mortgage industry pulls your score, you just want to make sure that it's done within a 2-week window. And then we should see the exact same scores. If you go over the 2 weeks, then, it's going to, you moved out of that timeline, and you're going to see, where the scores might get dinged a little bit, because you're going to have the next pull as a separate pull after the fact within that window. And honestly, Alex, that change only happened, I think, about 3 years ago. They kind of finally figured out that, wow, geez, maybe consumers do shop around a little bit for mortgage financing. So back in the day, if I pulled your credit today on a Tuesday, and then somebody else pulled it the next day on Wednesday, it would have an effect on the scores. But that did change. And so as long as you're within that 2-week window, mm-hmm. after the first person pulls the scores, the tri-merge, anybody else behind for the next 2 weeks is going to see the exact same thing. So,
yeah, that's how it should work, and like you said, it's not always perfect that way. And the tough part is that everybody has overbearing regulation on this. So you have the credit bureaus that come out and say it's 2 weeks, and then you have the Fair Credit Reporting Act that says it's 30 days. And then you have the CFPB last year that came out and said, well, no, you got 45 days. I think the 2-week window is pretty comfortable to say, hey, if you're shopping within 2 weeks, you really shouldn't see a huge variance in your scores.
Right.
So that's good advice. And one thing that we don't have a lot of time, but one thing I also want to touch on is, when you're working with consumers who are worried about, trying to gamify credit scoring, they're at a 620, but they think, okay, I'm going to go over here and get a 630 credit score.
Right.
They're kind of missing the point, right? I mean, it's not so much about the score, it's about healthy content. Because at the end of the day, you're going to look at scores, but you're also going to look at content, right?
Yeah, and that's a great point. The scoring game has become, I kind of joke, it's kind of a blood sport. And remember, folks, it's because, these people, the data's already out there, and most of these companies already have access to it. Well, they've discovered a separate revenue stream, by selling credit monitoring through Credit Karma and other, there's 100 other companies that do it. So it's just ancillary money for them. So they've promoted this whole scoring mania thing. And one of the things I'll tell people is, once your score gets above a 740, you're going to get the lowest cost possible on mortgage financing. Your interest rate's going to be as low as it can go. So a lot of people will say, I'm a 765, I'm a 785, I'm an 803, whatever. Well, I don't want to burst your bubble, but it just doesn't really matter. Once you get to a certain amount. And
don't tell them that.
Content's huge because the main driver of the scoring models obviously is how you pay your bills. Mm-hmm. And so it's not, that it's about a 634, this and that, it is about the content. It's paying your bills on time. And there's really kind of two main things I want to stress on that. There's this idea of, credit repair and getting your scores up, which is what everyone's very transfixed on. But that's only half the battle. The other half is actually building and maintaining good credit trade lines. Mm-hmm. So sort of the magic formula for that, for folks that are trying to build their credit, either that don't have any credit at all or had bad credit and they focus really hard on getting rid of their bad credit. Well, you still got to build the good credit. And the way you do that, it's 2 revolving and 1 installment, right? So what does that mean? It means that, an installment loan is a set period of time, set interest rate, like a car loan. You pay X amount a month for a certain amount of time. So if you're trying to build your credit or rebuild your credit, getting an installment loan and paying it like a champ is super important. One installment loan. And then you want to combine that with 2 revolving accounts. And a revolving, that's your credit card, So in Utah, a real lay down is, go to RC Willie. If you've got a Pulse, they're going to give you $300. You can go to the credit department, get an RC Willie card. That's a good source. Online, companies like Capital One, they'll pretty much give anybody a card for $300. That's another easy way to do it. And then here locally, I've got a great friend. I'm happy to promote these guys. KeyBank does a secured card. They're a big bank. They're obviously legitimate. You can do, I think, from $300 on up. So that means that you go in, you get an account with them, you give them $300. They give you a credit card worth $300. It's a secured card, right? So it's getting into the idea of content. That's kind of the magic formula is 2 revolving and 1 installment. Of course, if you have more, that's okay too. But when you're trying to rebuild or start credit, those are the 3 things you want to do: 2 revolving and 1 installment.
Yeah, that's really good information. And one thing that I'll kind of promote is we've got a free resources tab on our website that has a lot of information there. KeyBank historically has been really good. Capital One, everything that you mentioned is dead on.
Right.
You can get deeper into the weeds on that on our website if you have more questions.
Sure.
But I'm glad that you touched on that because, the name of this is, why are there so many different credit scores and how do you navigate that? And I think the best way to kind of finish out this video so we don't put too many people to sleep. Credit is, Joe, it can be kind of boring.
It's pretty exciting stuff, Alex.
But we really want to, kind of wrap up with just clarifying that it's not going to get any better. You have multiple different credit scores because you have multiple different algorithms. And all of these different algorithms, whether they're all housed under the same company like FICO, you have the mortgage industry that uses algorithms 2, 4, and 5. You have algorithms FICO 8 that got released in 2011. You have all of these different new FICO XD, FICO Ultra, FICO 9. You have all of these different credit scores coming out from one company. And then you have all of these other different scoring models that are almost unlimited at this point, that individual banks, smaller lending institutions that are non-mortgage, they're starting to kind of gravitate to. So the challenge of multiple different credit scores, it's not going to change much. It's only going to get more complicated. And down the road, in terms of mortgages, with some new legislation that got passed, we could see more competition within the mortgage industry for credit scores as well. So that point that Joe touched on, which is healthy content, you can kind of put the scores aside. If you don't have healthy content, if you have a lack of credit history, or if your credit invisible, or if you've gone through a life event, right? You're not going to have a good credit score regardless of where you pull. So if you focus on the content, if you focus on the things that matter, which is paying your bills on time, utilizing credit cards properly, not having outstanding derogatory debts, not looking for credit too much like Joe talked about, that's a big one, right? If you can manage those things, regardless of what credit scoring model you use, whether it's Credit Karma, FICO 9, whatever it is, you're going to be able to credit qualify. Is that a pretty decent message for future home buyers?
Yeah, absolutely. And then the other one thing I do want to point out, just as kind of a, not too much in the weeds here, but it is a big deal. When people have multiple credit cards, we teach people all the time that, it's about your utilization. If your limit, you want to keep your utilization below 30% of your limit. Well, what does that mean? Well, it's real simple. If you have a card that's got $1,000 limit on it, you want to keep your balance at or below 30% of that, which is $300. You also need to kind of keep in mind that you got to have to build in for the interest they're going to charge you too. So if you've got $1,000 limit, you don't want the balance at 300. You want it more like at 280-ish, so that because they bake the interest into it too, so that the balance and the interest together stay below 30%. And what I see a lot of people do is they say, well, geez, I have 4 or 5 credit cards, and they get the offer in the mail for the consolidation, the interest free, the 0% interest, game.
Yeah.
And, we know why credit card companies do that, because people, don't stick to it and then they slam them, right?
Mm-hmm.
But a big mistake I see is people will consolidate, 4 or 5 credit cards where they were below 30% of the utilization, and they'll put it onto one card that then ends up being maxed out.
Yeah.
Guys, that will hurt your credit. You're better to have 5 cards or 4 cards all at or below a 30% balance based on the limit than you are to pile all those onto one new one at the 0% that's maxed out. That will hurt your credit. So that's a little thing that I don't know that anybody's teaching that, but it's a big deal, and I run into that quite often as well.
Yeah, that's a good point. Well, we hope that this was valuable information for everybody. Joe, you're so awesome for coming on and doing this. I'm sorry for the confusion with Facebook Live.
Worries.
I'm going to figure it out one of these days. But Joe, you're the best. If you guys have any questions for Joe, Joe's over at Latitude Lending, does a fantastic job, really knocks it out of the park for his clients. We've had probably close to 6 or 7 years worth of experience together, helping create home buyers, and I couldn't advocate more for Joe. So Joe, thank you so much. If you guys have any additional questions, hit us up. We'd love to answer them for you. Otherwise, have a great Wednesday, and I'm sure we'll talk to y'all soon. Thanks, Joe.
Thanks.